Market crashes can feel scary, but panicking won't help your portfolio. In this video, I'll walk you through the smart steps to take when the market dips, how to protect your investments, spot buying opportunities, and keep a long-term perspective. Whether you're a beginner or a seasoned investor, having a plan for downturns is key to staying confident and growing your wealth. Let's get you ready for any market shakeup. Today we will talk about what to do when the market crashes. So before we start, make sure to hit the like button and subscribe to my channel. 1. Stay calm and avoid panic selling. The most important thing to do during a market crash is to remain calm. Emotional decisions, especially panic selling, often lead to poor outcomes. When prices drop suddenly, the instinct may be to cut losses before things get worse. However, history has shown that markets tend to recover over time. Selling during a downturn locks in your losses and can make it difficult to re-enter at the right time. Remember, market crashes are part of the investing cycle and are usually temporary. Instead of reacting impulsively, take a step back and assess your overall financial picture. Ask yourself, has my investment horizon changed? Do I need the money soon, or am I investing for the long term? Long-term investors should view downturns as expected bumps on the road to growth. By staying focused and avoiding knee-jerk reactions, you protect yourself from emotional mistakes that can derail your financial goals. Keep in mind that some of the best investing days come shortly after the worst ones. Missing these recovery days because you sold out during a crash can have a serious impact on long-term returns. Patience and perspective are your most valuable tools during uncertain times. 2. Revisit your investment strategy. Market crashes offer a great opportunity to revisit your investment strategy. If you created a financial plan based on your goals, time horizon, and risk tolerance, now is the time to evaluate whether that plan still makes sense, not to abandon it. A well-diversified portfolio that aligns with your risk profile should already account for market downturns. If you find yourself overly anxious or suffering significant losses that feel unbearable, it may be a sign your asset allocation was too aggressive to begin with. Use the crash as a learning experience. Review your mix of stocks, bonds, and cash. Consider whether your portfolio needs more defensive positions like dividend-paying stocks, gold, or bonds. But avoid making drastic changes in the heat of the moment. Adjustments should be thoughtful and based on long-term goals, not market emotions. If you're working with a financial advisor, now is a good time to touch base. A second opinion from a professional can provide clarity and reassurance. A crash is not the time to abandon your plan. It's the time to ensure that your plan was built for exactly this kind of event. A sound strategy should be able to weather storms and still keep you on course. 3. Continue investing if possible. If your financial situation allows, continuing to invest during a market crash can be one of the best moves you make. When stock prices fall, you're essentially buying shares on sale. This concept, known as dollar cost averaging, allows you to buy more shares to the same amount of money. Over time, this strategy can significantly lower your average cost per share and boost long-term returns. Many of the most successful investors, including Warren Buffett, advocate for being greedy when others are fearful. Crashes are scary, but they often present opportunities to acquire quality assets at discounted prices. If you're contributing regularly to a 401(k) IRA or brokerage account, resist the urge to pause or reduce contributions. Stick to your investment schedule and think long-term. For those with extra cash reserves, a market downturn may also be a time to consider increasing investment amounts if you can do so without disrupting your emergency savings. Of course, you should never invest money you'll need in the short term. But for long-term goals like retirement or college savings, continuing to invest during a downturn can help you come out ahead when the market rebounds. 4. Evaluate buying opportunities. During a market crash, certain stocks or sectors may become significantly undervalued, providing opportunities for savvy investors. This doesn't mean jumping in blindly, but it is a chance to review your watch list. Look for high-quality companies with strong balance sheets, consistent cash flow, and competitive advantages that are temporarily beaten down by market panic. Sectors like technology, healthcare, consumer staples, or utilities often present attractive entry points during downturns. Similarly, dividend-paying stocks or ETFs might offer enhanced yields after price drops. If you're more conservative, consider allocating funds to broad market ETFs rather than individual stocks. These offer built-in diversification and lower risk compared to single equities. Rebalancing your portfolio is another smart move, selling assets that have held up relatively well and using the proceeds to buy those that have fallen significantly. This keeps your portfolio aligned with your target allocation while taking advantage of price dislocations. Always do your due diligence. Crashes can drag down good and bad companies alike, but only the good ones are likely to recover quickly. Taking the time to research and invest wisely during a crash can position your portfolio for long-term success once the recovery begins. 5. Strengthen your emergency fund. One of the best ways to feel secure during a market crash is to ensure you have a robust emergency fund. This is the money you set aside in cash or liquid savings to cover 3 to 6 months of essential expenses in case of job loss, medical emergency, or other financial shocks. A crash often coincides with economic downturns, which can increase the likelihood of income disruption. If you don't already have an emergency fund, now is the time to start building one, even if slowly. If you have one, review its adequacy. Knowing you have a safety net can reduce the pressure to sell investments prematurely and give your portfolio time to recover. Your emergency fund should be kept separate from your investment accounts, ideally in a high-yield savings account or money market fund. This cash reserve gives you the confidence to stay invested and avoid panic decisions. It also helps you take advantage of buying opportunities without jeopardizing your day-to-day financial security. Remember, markets go through cycles and recovery can take time. Having liquid reserves helps you ride out the storm without derailing your financial plan. 6. Avoid timing the market. Trying to perfectly time the bottom of a market crash is nearly impossible. Even seasoned investors and professionals fail at it consistently. The market is influenced by countless variables: economic data, corporate earnings, geopolitical tensions, interest rate changes, and investor sentiment, all of which are unpredictable. Instead of attempting to jump in or out at the right moment, stick with a disciplined investment approach. Use dollar-cost averaging to spread your investments over time, which minimizes the impact of short-term volatility. Often the best days in the market come shortly after the worst. Missing just a few of these rebound days can severely reduce your long-term returns. For example, missing the 10 best days in a decade-long investment window can cut your portfolio gains significantly. Timing the market also adds stress and emotional strain, causing many investors to second-guess every move. A better strategy is to stay invested in a diversified portfolio suited to your goals. Over time, this approach tends to outperform efforts to move in and out of the market. Remember, it's time in the market, not timing the market, that builds wealth. Patience and discipline are your greatest advantages as an investor. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.